Welcome to Talk Tickers.
We're here to give you the shortcut, the fast track, really, to understanding crucial earnings calls.
Exactly. And today we're diving into a recent one. Our job, as always, is to pull out the key info, the insights you actually need, without wasting your time.
All right, let's get into it. So first quarter 2025 looked pretty strong overall.
Yeah. What were the headline numbers?
Well, both GAAP and adjusted earnings per share came in at $1.30.
Okay, $1.30. And how does that compare?
Good question. Adjusted EPS, it was up 4% from the last quarter, and a really significant jump, 65% year over year.
Wow, 65%.
Yeah, although it's fair to point out it's more like 53% if you back out that FDIC special assessment charge they had. Still very strong, though.
Okay, 53% ex FDIC. Still impressive. What drove that? Was it just cost cutting?
Not just that, no.
Oh.
I mean, disciplined expense management was definitely part of it, but they also pointed to net interest margin expansion and, interestingly, lower provision for credit losses.
Lower provisions, okay. And loan growth.
That was a big piece, too. Funded loan production hit its highest level since late 2022. That led to about $40 million in actual loan growth on the books.
Highest since Q4 22. Got it.
And on the credit side, net charge-offs dropped down to just 20 basis points.
Pretty low.
Very low, yeah. Suggests broad improvement in credit quality metrics. And all this together pushed the adjusted return on tangible equity up to 17.6%.
So solid performance, healthy returns. Sounds good.
It does, but, there was a bit of nuance in the sentiment from their commercial clients.
Oh, what did you pick up there?
Well, it's interesting. Their survey showed an uptick in negative sentiment about future business activity. The folks expecting a decline went from 10% up to 17%.
Not insignificant. Any reason given? Tariffs, maybe?
That seems to be a factor. About 20% of clients mentioned they expect a meaningful impact from increased tariffs.
Okay.
But, and this is the key thing, the percentage expecting increased activity actually held steady at 41%, same as the last survey.
So a split view then. Some getting nervous, but a larger group still optimistic.
Exactly. It kind of raises the question if we're seeing a bit of a split, maybe depending on the industry or type of client, something to watch.
Definitely. Okay, so strong Q1, but maybe some mixed signals on the horizon. Let's dig deeper. How did the revenues and expenses break down?
Right, so they actually achieved positive operating leverage year over year.
Meaning revenue grew faster than costs?
Precisely. Adjusted revenue was up 7% compared to last year. And on the flip side, adjusted non-interest expense actually fell 3% year over year.
Even better.
Yeah, though if you strip out that FDIC assessment impact, it was basically flat year over year on expenses. So good control there.
Makes sense. And the core driver, net interest income.
NII was $454 million. That's up 8% year over year. It was flat compared to Q4, but they said that was mainly just due to fewer days in the quarter.
Okay, standard seasonal thing. And the margin itself, that expanded, right?
It did. Net interest margin, or NI, landed at 3.35%. That's a 7 basis point increase from Q4.
What helped push that up?
A few things. They mentioned effective deposit repricing, basically managing what they pay out on deposits. Also, some hedges matured. They held lower cash balances, and the Fed funds rate was pretty stable during the period.
Any offsets?
Yeah, they did issue some debt, which partially offset those positive factors.
And looking ahead for NIM Q2.
They're guiding for relatively stable, but the big caveat is always Fed policy. That's the main driver.
Always is. Okay, what about the other side of revenue? Non-interest income.
Adjusted non-interest revenue was $117 million. Now, that was down sequentially, but it was actually up 1% compared to last year.
Okay, modest year-over-year growth. Any highlights within that?
Yeah, core banking fees look good, up 6% year over year. Things like treasury and payment solutions, card fees, those performed well.
And capital markets.
Also up year over year by 5%. But like the total non-interest revenue, it was down sequentially. They put that down to the mix of loan production and just, normal seasonality and wealth management.
Got it. And we touched on expenses being controlled. Anything more there?
Just that they managed it well, flat sequentially, down year over year on an adjusted basis. They pointed to managing employment costs, project spending, and also some credit-related costs.
Okay, disciplined approach. Let's pivot to the loan portfolio. You mentioned growth. Where did they see that traction?
Right, so the overall balance was up $40 million at period end. But the really interesting part is the annualized growth in what they call their high growth lines.
Which are?
Middle market, specialty lending, and corporate and investment banking. Those grew at an 8% annualized clip.
Nice. And the actual funding activity?
That really surged. Funded loan production up 16% quarter over quarter. And get this, 89% year over year.
89%. Wow.
Yeah, they said it was their strongest quarter for wholesale banking production in 2 years. So definitely some momentum there.
Okay, that's significant momentum. What about funding that growth? How did deposits look?
Deposits held up well too. Core deposits grew 3% year over year, and the mix actually improved a bit.
That's so.
They saw growth in money market accounts, interest-bearing demand, and savings. That offset a drop in time deposits, like CDs. And non-interest-bearing accounts, those were pretty stable.
And the cost of those deposits?
It actually came down. Average cost declined 20 basis points, down to 2.26%.
Interesting. What about their deposit beta? How sensitive are their deposit costs to rate changes?
They calculated it at 46% through this recent easing cycle. So moderately sensitive, I'd say. Not chasing rates super aggressively, but not immune either.
Makes sense. And credit quality, again, low charge-offs, anything else? Non-performing loans?
Non-performing loans also improved. They fell to 0.67% of total loans. So generally positive trends on the credit front.
Good. And it sounds like they're trying to stay ahead of potential issues?
Yeah, I think that's fair. The allowance for credit losses was 1.24%. That's actually down slightly because of those good trends. But they did incorporate a more adverse economic outlook into their models, which offset some of that improvement. They specifically flagged looking at risks from policy changes, like tariffs or impacts on government contracts, being proactive.
Right, trying to anticipate. Okay, what about their overall financial strength? Capital levels? Any strategic updates?
Capital looks quite strong. Preliminary Common Equity Tier 1, the CET1 ratio, was at 10.75%. Total risk-based capital at 13.65%. So well capitalized.
Comfortable buffers.
Definitely. And strategically, they seem to be executing. Relationship manager hiring is apparently on track. They hit about 20% of their 2025 goal by mid-April.
Okay.
They're also expanding their structured lending team, deepening coverage in financial institutions, and they officially launched that legal industry deposit vertical they've been talking about.
So investing in growth areas.
Yeah, the message seems to be prudent investment for the long term, but keeping a close eye on expenses relative to how revenue is growing. Balancing act.
Got it. So with all that context, what did they guide for the rest of 2025? What are the assumptions?
Okay, their guidance assumes more moderate economic growth overall. Critically, it includes 4 Fed funds rate cuts.
4 cuts baked in?
Yep. And assumes the 10-year Treasury yield stays roughly where it is now. Based on that, they expect period-end loan growth of 3 to 5%.
Focused on those growth areas again?
Primarily, yes. Yeah. Middle market, CIB, specialty lending, and they expect core deposit growth to match that, also 3 to 5%.
And revenue?
Adjusted revenue growth projected at 3 to 6%. Within that, adjusted non-interest revenue is guided to be between $485 million and $505 million.
Expenses.
Adjusted non-interest expense expected to grow 2 to 4%. So still aiming for that positive operating leverage looks like.
And charge-offs, you said Q1 was low.
They expect charge-offs to be relatively stable sequentially in Q2, which is actually below what they previously guided. So continued confidence in credit quality for now.
Good sign. Capital target.
Targeting a relatively stable CET1 ratio around that 10.75% level.
Yeah.
They explicitly said loan growth is the priority for using capital right now.
Okay. And taxes.
Expecting a pretty stable effective tax rate, around 22%.
Okay, that gives us a clear picture of their outlook. Did they offer any more color on just the general lending environment they're seeing? Beyond their own number.
They did. They acknowledged, the uncertainty around the recent tariff announcements. We talked about that client survey.
Right, the 41% still expecting growth despite the concern.
Exactly.
Yeah.
And they are seeing that loan production momentum accelerate. They expect those faster growing segments, middle market, structured lending, CIB, to keep up a strong pace, maybe 10-15% growth.
What about loan payoffs? Sometimes that can be a headwind.
It's still elevated, they said. Payoff activities eased off a bit from peak levels, but it's higher than the long-term average.
Okay.
They're assuming line utilization stays flat, but they did note, hey, if rates come down, maybe businesses draw more on their lines.
A potential upside surprise there.
Could be. And they also stress that gaining market share is a core part of their strategy, not just relying on the market lifting all boats.
Makes sense. Competitive environment. What about the NIM outlook again? You said stable in Q2, but sensitive to the Fed.
Right. They seem pretty pleased with how the margin's been moving. Q2 stable, yes. But the guidance with those 4 Fed cuts, 1 in June, 3 more later, creates this interesting dynamic.
How so?
They expect a sort of temporary lead lag effect. The benefit they get from their assets repricing at lower rates gets offset for a bit, leading to that stable margin forecast in the mid 3.30s for the year.
But what if the Fed doesn't cut 4 times? What if rates stay flat?
Ah, good question. In that scenario, they actually see the margin expanding more, potentially reaching the low 3.40s by year end. So the cuts actually dampen the near-term margin expansion, paradoxically.
Interesting dynamic. Okay, expense management. They revised guidance down slightly. Any more detail on why?
Well, their main strategic goals haven't changed, and RM hiring is on track. They did hint they might slow down hiring a bit in wealth management, just given market volatility.
Understood.
But the bigger drivers of the lower expense guidance were things like lower projected costs for certain projects, some facilities savings, and also lower credit-related costs, like legal fees and fraud expenses.
So some efficiency gains and maybe some better than expected credit costs.
Seems like it. And they made a point of saying they have flexibility. If the economy really takes a nosedive, they can pull back on initiatives, pause hiring, keeping options open.
Prudent. What about any specific credit portfolio details? Anything jump out?
They mentioned an office loan charge-off, but it was tied to a relationship they already had marked as non-performing. They sounded somewhat hopeful about resolving it.
Office is always a focus area these days.
Definitely. And related to the broader economy, they did increase the weighting they give to an adverse economic scenario in their allowance calculation as of March 31st, just reflecting that uncertainty out there.
What does that adverse scenario look like?
It's based on Moody's downside scenario. Peak unemployment hitting 8.3% in 2026. That gets a 20% weight in their calculation. Their baseline sees unemployment peaking around 5.3%.
Okay, so they are stress testing for something pretty tough.
They are. Although the underlying performance of the loans actually improved their models, it was offset by layering on that tougher economic outlook. They also stressed their portfolio is different now, less sensitive perhaps than during the GFC or the pandemic.
And capital flexibility.
Yeah, they feel the capital they generate gives them room for loan growth, but also potentially share buybacks. They'll weigh the growth opportunities against buybacks as things unfold.
Okay. You mentioned tariffs and policy changes earlier. Did they talk more about how they're analyzing the potential impact from, say, Washington, D.C. policy shifts?
They did. They acknowledged it's hard to pinpoint the exact impact client by client.
Sure.
But they did look at their portfolio exposure in industries that might be affected: manufacturing, transportation, government contracting, retail. They felt their exposure was fairly limited overall.
Any direct feedback from clients?
Yeah, they reached out to their top 100 borrowers. About 15% of those expect a meaningful direct impact, mostly through higher input costs. And a quarterly survey had about 20% of all clients feeling some direct tariff impact.
Consistent with the earlier sentiment numbers.
Right. And remember, even with that negative sentiment rising from 10% to 17%, you still had 41% expecting growth. So it's a mixed bag. They mentioned using tools like daily line utilization monitoring and a trade tracker to keep tabs on things.
So using data to monitor in real time.
Seems like it. They also highlighted that the overall health of the consumer is probably the biggest factor to watch. And they feel their own balance sheet de-risking, revenue diversification, and higher capital levels give them more resilience now.
Makes sense. What about asset repricing? Specifically fixed rate assets, how much benefit do they still expect from those rolling over?
Yeah, that's tied more to the sort of middle and longer end of the yield curve, which has been volatile, as you know. But they said the expected benefit from fixed rate assets repricing this year is actually very similar to what they guided before. And it should continue into next year, maybe just a little less in 2026, if rates do come down as projected.
And that benefit is part of why the margin could hit the low 3.40s by year end if rates stay flat.
Exactly. That repricing benefit would really shine through in a flat rate world.
Okay. Let's talk about capital markets revenue again. It was down sequentially. Any more detail on what drove that specific dip?
Yeah, the main culprits sequentially were lower fees from derivatives and swaps, and also lower fees from being the lead arranger on syndicated loans.
Why lower swap and syndication fees?
Well, fewer really large loans went through the syndication market in Q1. And, with the expectation of rates falling, clients were apparently less eager to swap their variable rate debt into fixed rates.
Waiting for potentially lower fixed rates down the road.
Plausibly, yeah. But they did see increases in other areas like debt, capital markets advisory, foreign exchange, and SBA loan guarantee sales.
So some parts up, some down.
Right. And they do anticipate more syndication. And swap income should pick up as loan production ramps up, and depending on how the rate environment actually evolves.
Okay. And deposit costs. They came down in Q1. How are they thinking about managing that going forward, especially if the Fed does cut?
They seem pleased with their deposit beta. So far, they cited 48% using the March month-end number.
Higher than the cycle average you mentioned earlier?
Slightly, yeah. Depends on the exact calculation timing. But looking forward into the easing cycle, they expect a beta around 45%.
So they expect deposit costs to come down, but maybe not quite as fast as the Fed cuts rates?
That's the implication of a beta below 100%, yes. They also noted Q1 was a bit unusual with that shift out of time deposits and into money market accounts. For the rest of the year, they expect deposit growth to come mainly from non-maturity interest-bearing accounts, with non-interest-bearing staying relatively stable.
Got it. Did they mention technology investments? Are those helping them manage risk or find opportunities?
They did touch on that. They feel investments in tech, like tools for monthly cash flow monitoring or that daily line utilization tracker, have definitely improved their ability to monitor credits and get earlier warnings if things start to deteriorate.
So better risk management through tech.
Yeah. Better overall processes and procedures, they argued. Plus, the balance sheet diversification helps reduce concentrations compared to, say, the GFC era.
Okay. And digging into credit performance drivers a bit more, any specific portfolio segments driving the improvements or causing concern?
They mentioned favorable trends in their seniors housing portfolio, some upgrades there, M&A activity helping resolve some situations.
Okay.
Multifamily within commercial real estate continues to perform well, low losses, low non-performers. Office, as we discussed, they're working through that one large non-performer, but seeing maybe some glimmers of hope in valuations there.
Glimmers of hope in office CRE. Interesting.
Yeah, take it for what it's worth. Their models apparently showed a slight increase in the lifetime loss estimate for the retail portfolio, but that was offset by a slight decrease on the CRE side overall.
Okay, puts and takes. What about loan paydown activity? You said it was elevated but had subsided a bit. Is that still a major headwind?
It's still running about $150 million above their long-term average per quarter, so it's noticeable. But down from where it was,
What's driving the payoffs?
a mix of things. Some M&A transactions, some permanent financing takeouts in commercial real estate and C&I lending, and just some businesses choosing to pay down lines because rates are higher.
Makes sense. But not derailing their growth guidance.
Apparently not. They seem to have factored it into their 3-5% loan growth target. They did add that mortgage payoff activity could pick up if the 10-year Treasury yield moves significantly lower, but that's more on the consumer side.
Right. Final point before the trade ideas. What about the pricing environment for new loans? Is it still competitive out there?
Oh yeah, definitely competitive. They confirmed that spreads and yields on new loans are coming down, basically as they expected.
Any specific numbers?
The average yield on new funded loan production in Q1 was 6.90%. That's down from 7.19% in the previous quarter.
Okay, noticeable decline.
Yeah. But they also noted the yield on new deposit production was 2.58%. So the spread on new loans over new deposits was still pretty healthy at 4.32%.
So still profitable growth, just at slightly tighter margins than before.
Exactly. They're constantly evaluating pricing based on their return hurdles and what the competition is doing. Standard practice.
Okay, that gives us a really thorough picture. Great detail. Now let's shift gears to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on this call. What have you got?
Okay, idea number 1. We heard them talk about anticipating 4 Fed cuts in their guidance, and they noted line utilization could increase if rates fall, making borrowing cheaper. So the trade idea. Maybe consider a long position in companies, particularly in sectors this bank lends to, like middle market or specialty, that have significant undrawn credit lines. The thinking is, if rates fall, these companies might tap those lines more readily, boosting their activity or investments.
Okay, betting on increased borrowing from companies with existing capacity, how would you hedge that?
Maybe pair it with a short position in companies whose entire business model thrives specifically on very high interest rates. Maybe certain types of lenders or financial service firms that might see margin compression if rates fall significantly.
Interesting angle. Okay, what's idea number 2?
This one keys off their strategic focus. They specifically mentioned launching and expanding their deposit vertical for the legal industry. And they talked about growth in core banking fees like treasury management.
Okay, the legal focus.
Yeah. The legal sector is often seen as pretty resilient, even during downturns. So the idea is explore a long position in companies providing really essential, maybe niche software or critical services specifically to law firms. Think specialized practice management software, critical legal research platforms, maybe cybersecurity tailored for law firms.
Betting on the stickiness and necessity of those services for law firms regardless of the broader economy.
Exactly. The bet is on consistent, maybe even growing demand there. And for a potential pair, maybe a short position in a sector that's highly sensitive to, say, government spending cuts, given some background noise about potential fiscal tightening or agency belt tightening down the line.
Okay, focusing on niche B2B services versus maybe government-dependent sectors. Got it. Two interesting ideas to chew on there.
Definitely food for thought.
Absolutely. And just to reiterate, everyone, this analysis and these trade ideas are purely for informational purposes. This is not financial advice. Please do your own homework and consult with a professional before making any investment decisions.
Couldn't agree more.
So that was our deep dive into this earnings call, the key numbers, the strategic insights, and some creative thinking. We hope this gave you a clear, concise understanding of what mattered.
What stood out to you listening? We're always interested in different perspectives.
Indeed. Thanks for tuning in to Talk Tickers. Join us next time for another earnings call deep dive.